Good morning and welcome back to the Real Wealth Solutions podcast. My name is Greg Scully, joined as always by my co-host Darren Light. Today we are joined by Nick Earls and Eric DeNicola. Did I murder that or was that close
No,
enough?
you got it perfect. You hit it.
All right, right on. They are co-founders of Winterspring Capital. That section is a multifamily investment firm with a focus on Southeast and Midwest markets. And then they have another business, PWN Development, which has largely been, and correct me if I'm wrong, on the condo development side in the Boston area. So welcome, gentlemen. We appreciate you taking the time today. If you don't mind taking a minute or two for a little bit more personal bio introduction, we'd appreciate that. Nick, you wanna lead us off?
Yeah, thanks, guys. Excited to be here today. As you said, my name is Nick Earls. I came up in the real estate space since 2012. I got my start as an agent. And in 2015, I kind of went to Eric, who's been my friend since we were kids, actually a long 20-year friendship now, and said, "Hey, we've been talking about starting a company since we were 15 years old. Let's do it." I've been in the real estate space a few years. My brother is a carpenter, so we started our development company in 2015, and we've done mostly condominium projects in the Boston area. And in the past couple of years, we started raising money to purchase larger multifamily assets in out of state. We kind of built up our own portfolio here in Massachusetts for a few years, and just kind of realized, hey, the goal here is to get passive income and not have to do that much of work. I'm a big believer in economies of scale, and we were kind of buying these 3, 6, 8 unit buildings up here in Massachusetts and doing some self-management. We found managers, but there's a lot of work with the smaller multifamilies, and we started saying, hey, we're raising money for these development jobs. Some of them are very expensive, so we thought, why don't we take that skill set and start buying multifamily out of state? So we've been doing that now for about a year now. That's kind of been the trajectory of the company. We do condo projects up here, more on the luxury side, getting into affordable housing as well, and buying multifamily out of state and kind of high growth markets, mostly in the Southeast.
Yeah, and just to kind of follow up with that, as Nick said, we've known each other for 20 years. He brought me in 2015. I was actually down. We're both from Boston, but the Boston area, south of Boston. I was down working in New York City, working in a firm that dealt with private equity. Also had worked in public equity before that. So I had a finance background. And like Nick said, we knew we wanted to start a company. So he brought me in. He kind of filled you in from that point on. But just to sort of add to what he said, we got to the point where we had investors we were bringing on so that we could take on multiple development jobs at once. Boston's a big condo market, maybe more so than some others where, a lot of developers might build to sell condos to the end users versus, building a apartment building that they could hold on to or sell as an investment. Property prices are very high up here, so a lot of the numbers, it's more difficult to make things work as a sort of a build and hold, versus the price for condos on a square foot basis is so high, and there's so much demand that's sort of a niche we saw and stuck with. But we started to expand over the last year or two into, as Nick said, larger syndicated multifamily deals.
Okay, right on. Yeah, you answered some of my questions I had about on the development side. I saw your completed projects page on your website, a dozen plus completed projects. They all look smaller in size, and they are all very nicely done on the finishes side. And I was wondering if that was a product of the anticipation of the market or lot size or zoning, and then also why you went with the condo model instead of the market rent model. It sounds like it's largely a function of just the local economy doesn't really support the develop and hold very much.
Yeah, absolutely. If you're going to develop something that you want to rent out, you're either going to have to put a lot of cash in so you have equity in it from the start, or you're going to have to build pretty big here to make the numbers work. Um, we kind of started off, I had the goal, and I had been discussing this with Eric since we were teenagers, of buying rental properties, and just, doing it the traditional way, gradually getting more and more over time, pulling refinances, fixing them up. But around 2015, the condo market in Boston was really starting to pick up. And Eric and I had been, for a couple of years at that point, we had a goal of starting the company. As we said, we didn't really know what we were doing at that point. We were still in the early phases of learning. So we just thought, okay, we got to save up a bunch of money for a down payment. We didn't know about investors or anything like that. But we had a goal of saving up, I don't know, like a little over 100 grand. And it took us like years to do it. We were squirreling away money, and we were going to buy a rental. But then by the time 2015 hit, when we had saved up all the money, we started to notice condos in Boston were really taking off. We were kind of getting to the point of full recovery after the previous recession. And a couple markets in Boston that had been just kind of considered like, oh, I wouldn't live there, it's not a nice area, they were starting to really gentrify. One of those markets is East Boston. That's where the Logan Airport is. And people used to say, I don't want to live there. The airplane's always flying over. When we started in 2015, you would buy a condo there for around $400 a square foot. Today, $700 a square foot. So that market is, in the past 5-6 years, really taken off. So we couldn't ignore the data in front of us. We said, all right, let's kind of pivot. We'll get to the rentals, but let's use this money we've saved up and get into condos, because we saw the opportunity to maybe multiply our money pretty quickly. Um, and that's kind of what happened. We went from doing our first project was a 2-family that we saw by right. The zoning, you could do 3 units. So we kind of added to it. And then since then, we've mostly been doing new construction. And as we built up our profits from those projects, we kind of circled back and went to the rentals. But it was mostly, we just saw the opportunity in front of us. And it's still, the market for condos in Boston is still performing really well. We have an upcoming project in Brighton, which is about 5 minutes from Harvard and MIT. It's a real like research university area. And that one's like it's going to be 32 units. It's around a $25 million projected sellout for all the condos. But that market is, you can get up to 900, $1,000 a square foot for condos there. So it's one of the um, most expensive, most successful condo markets actually in the country, right up there with San Francisco, according to some data I've looked at. So it's really just the market dynamic, as you said. And our goal is not to be doing these construction jobs for the rest of our lives, but we've kind of carved out a niche with it. We're looking for that, buying big multifamily properties like we've been doing for the past year or two here, and getting a property manager in place and really focusing on asset management. We're numbers people, but at the same time, the development thing is very lucrative, and it's a good kind of, to get the short-term profits from development and balance it out with the long-term profits from holding like bigger assets for a longer period of time. It's kind of a good, we've kind of just come to this middle ground where we do a little bit of both, and it's been helping us grow pretty quickly, I'd say.
Educate us, if you can, more about why Boston and the San Franciscos make a good condo market. Is it the way the land is parceled out? Is it the end user, the way their lifestyle is, the crowdedness of the city? What makes it a great market for that?
Well, for Boston, it's a combination of a couple of things. The biggest thing I would say is the supply and demand imbalance. So there's a huge demand. The population in the past 10 years, they did a projection of population growth by the year 2020, I believe it was, in 2010. And we had already surpassed those expectations by 2015. So the population's been exploding. some of those people are coming from out of state, but a lot of people are in state, moving from the suburbs and more rural areas into the city because the traffic here has become a nightmare. Just commuting in is it's actually literally become infeasible for people. So people are looking to live closer to the city, and that's just driven demand way up through the roof. But at the same time, the city has a zoning code from the year 1950, and they're extremely bureaucratic. There's a bunch of red tape. You have to get a stamp of approval from a bunch of different agencies to do most projects. Basically, the way they have it set up is most of the lots in Boston, the buildings that you see there, you couldn't actually build those without special permission. And I think they do it that way on purpose so they have more control.
Mhm.
But the end result of that is there's not much supply coming on every year because you got to get the stamp of approval from this counselor and this committee, and you got to do 500 neighborhood meetings. And at the end of the day, you get a project that like there's more compromise and middle ground maybe than in some other markets where developers get to do whatever they want. But it's actually hurting people, I'd say, because the prices just go up and up every year. The demand's not going away, and the supply is just strangled. And since COVID, they've been even worse. We got a couple of projects approved over the past few months, but it was a gauntlet getting through it with them, and everyone's taking a month off. And
Yeah,
that's what happens when it's bureaucracy.
I hear that as your pain point, although it's is a niche. It's supplying your funds for buying larger multifamily, as you said, and you're going to ride that out until you don't have to do it anymore. So you've got a great plan.
Well, and part of your market advantage then I think would be just your ability to navigate all that bureaucracy and stuff, because not everybody's going to have the stomach for that to go through. But hey, I thought everybody was leaving the Northeast and that you guys are just going to implode as a market in general because everybody's moving to Florida, and clearly that's not the case. I think what gets missed in a lot of that conversation is just migration within regions. You know, you see the same thing in California. Yeah, San Francisco had some out migration, but it went to Oakland or it went to wherever, you know, so it's not a blanket doomsday type thing for the Northeast at all. Things are changing, but you guys seem to be weathering the storm all right up there, huh?
Yeah, and I would say that's a good way to put it, weathering the storm, because it's always it's a fight, as Nick said, very bureaucratic, and as you just said, you know, sort of our value is we can navigate those waters, and so we're not seeing a huge outpour of people. You know, I'll talk to brokers in Florida, and they'll say, "Oh, another Northeast guy you're looking to buy down here." We're getting calls from you guys and New Yorkers, you know, every day, but as Nick said, the supply and demand situation in Boston specifically, and there's a lot of heavy duty employers there, a lot of biotech companies, the big universities. So there's always demand still, and we think it going forward to live there. And if you can navigate those waters and sort of get through that storm of bureaucracy and get to the finish line, a permanent project is worth a lot in the city of Boston.
Yeah, and you know, comparing and contrasting development versus buy and hold or buying existing projects, the development side, you know, we do a similar kind of strategy at a much smaller scale with our flips.
Right.
You know, we're doing some transactional stuff to build up capital to deploy into long-term hold cash flowing real estate. Is that essentially what your approach is? That you're taking what I caught on to is that, you know, you had said in your teens, you're like, hey, we should buy rental property, but you didn't ignore what the market was giving you in Boston. It's like, well, you know, that's not feasible here, but we can develop.
That's right.
You know, make some money and deploy it somewhere else where buy and hold makes a little bit more sense. Yeah, is there anything to compare and contrast the two vehicles beyond that was there something lacking in a development side that you saw in the syndicating existing complexes side?
Well, for us, I mean, the goal was always kind of that, you could say maybe cliched, but the cliched goal of most real estate investors, we kind of wanted mailbox money, cash flow coming in, and development is a harder job than most 9 to 5. So
Much
we're kind of
riskier.
going in the opposite direction of where we wanted to go. But it was a good way to bring in a lot of cash quickly that we could then leverage to get into that syndication world. So I don't mind, getting my hands dirty and doing some of that work, but it's just not something I want to do for the rest of my life. Whereas with syndication, asset management, working with best in class property managers, that's sort of just something we found ourselves much more comfortable with. We're numbers guys. When we were kids, we used to play competitive video games together. We're kind of like nerdier guys. So I feel more comfortable in that world with numbers and investors and big companies rather than talking to contractors. But I mean, we've had success with it, so we're not we're not going to abandon it completely, but it wasn't our ultimate goal. And in terms of just seeing the opportunity that's out there, I think that's one of the things we take pride in, is that regardless of what we're trying to do long term, if we see an opportunity, we're going to pounce on it if we think it's something that we're suited to. And one of those things is affordable housing development. I've been doing a lot of research on the affordable housing crisis in the country, and basically the way you'll get state and federal funding for affordable housing, and the main way that they do that is through the low income housing tax credit. But the affordability crisis keeps getting worse, and I predict that within the next 10 to 15 years, you're going to see new programs potentially on a federal level with a lot more funding for affordable housing. So based on that prediction, we start getting involved in affordable housing. So we're actually doing an affordable housing development. We're partnering with the city of Boston. These are actually going to be home ownership units, and it's a pretty cool project. It's going to be energy neutral, net zero project, where the building produces as much energy as it consumes, or in some cases, it actually produces more energy than it consumes. So we just kind of see that green energy, affordable housing, probably some degree of subsidization from local or state or federal government. We see that that's going to just get more and more important. So we're trying to position ourselves as one of the niches that we're in. And we're new to it. This is our first affordable housing development. But just kind of to your point about, yeah, we wanted to do rentals. That's our end goal, but we saw the opportunity there with condos. That's kind of always our mentality. Like, if we see the writing on the wall, hey, affordable housing is going to be big and you've got the skill set to do it, we figure we might as well get involved. We'd be stupid not to.
What I like about what you're describing is you've taken what you've learned on the new development side for the condos, and now you're able to apply it to this LIHTC programs, if you will, whatever they're going to be in the future. And I would think that with as many projects as you have done, even though you speak about the dirty bureaucracy that you have to go through, Greg and I are all about relationships and leveraging those in this space, because man, it's a team sport, right? I would think those relationships you've created and made with the local government has got to give you a leg up on your next new project going forward. Oh, well, this is Nick and Eric. Yeah, check the box. They're good. Whereas you've got these 1 or 2 timers that come through the city, may not be able to pull things off just because they don't know who you are and what you're all about.
And we've heard that already just doing this first project. We've already sort of got this first affordable project whisperings of that, where kind of the city, the group we're working with within the cities likes us and sort of says, yeah, well, this is a good starting point for working with us. If we have another proposal we put out, it'd be nice, to have you guys apply rather than starting with someone new, kind of that mentality. We can already sort of see that happening.
We've got some colleagues in Columbus, Ohio, and they specialize in purchasing existing LIHTC properties or Section 8, whichever one they are. And they've gotten so close with the authorities there. They are literally like, please let us know when you're buying another property, because we know how you'll run it. We know how you'll treat people there. And it's just this synergy there that works great on both sides. And you're still making great money in the end as an investor.
That's right. That's
Yeah,
great.
I'm curious, like sticking on the affordable housing side of things for a sec. It's next to impossible to build market rate affordable housing just because the price of construction doesn't allow for any money to be made at market rents. Are you keeping an eye out for disruptors that might change that? 3D printing comes to mind, or modular building of some kind or another. How far do you think we're out if such a thing would ever get to scale that it might actually make market affordable housing possible again? Or do you see that really tax credits or subsidies is going to be the way that that's going to be propped up for the foreseeable future?
We're kind of paying attention to all of it. We were actually just talking about 3D printed houses. Was that yesterday or the day before? So it's definitely on our minds. But from what I know of modular, we've never done modular. I actually know a developer who did a modular multifamily condo building. And according to him, the cost of construction was not really as much lower as you would hope it would be. So I don't, and this is just anecdotal, obviously, I've never done a modular myself. But our mentality is we want to be in a position that whatever happens, we already have built up a reputation as affordable housing developer. So maybe we could build those relationships with manufacturers, modular, 3D printed housing. I'm kind of skeptical that there will be a market solution to the problem anytime soon. But I really can't, I don't know, the economies of scale involved with 3D printing, if eventually their costs could get down. I'm not an expert in that, but my prediction would be there's got to be some kind of subsidy if we want to really solve this issue.
Yeah, that's kind of my understanding, is that same with like Connex building, there's people doing it with the shipping containers. That some of these things aren't necessarily bringing the cost down, but they are bringing things to market quicker. So from the development side, your holding costs go down and you're able to shorten the timeline. That has been, at least what I've, in my limited amount of research, that was the advantage it had, was that, a 24-month project would now go to market in 16 months or something. So it saves you money on the front end, but doesn't really save you money in total construction costs. I guess the holding costs go down. So.
And there are other, like, some people are coming up with interesting solutions, like the hospitality industry. There's a lot of distressed mom and pop hotels and motels.
Yeah.
Those could be easy conversions to kind of a natural affordable housing option. The dynamics of the cost of labor in your market that you're operating within can make a huge difference, because the cost of construction on a square foot basis could be wildly different from state to state, largely due to cost of labor, but also materials can differ from state to state as well.
Yeah. We're seeing that labor's a challenge in a lot of places here on June 22nd. Just finding regular old maintenance tech people, let alone truly skilled labor. I did not say that very well. I think you know what I mean, but if you're a maintenance tech out there, you have plenty of skills, but it may not be a licensed skill that is even more hard to nail down. But are you thinking about deploying the development side, like when you're looking at multifamily now? Are you looking for, hey, there's some vacant land with this, and let's see what the max amount of units that can go on this place may be? Are you looking to integrate the development with the multifamily as you're looking at projects where, maybe an average project, if you were to build out to the maximum amount of allowable units, might turn what a lot of people see as an average project into, a double, triple, or home run,
Yeah, I would say we are. I mean, when we look at some of these properties down in the southeast that were, that are stabilized, we're looking for value add potential. Maybe not extreme, but we're looking for some value add on the existing situation. But we're also looking at if there's a lot of land, sort of. I think what you're kind of just getting at as an example, when you look at the zoning code, I mean, we just looked at something in North Carolina. There's about 50 units, and there's a land use restriction on it for another 9 years based on what they can do there. And so that's kind of priced in right now. But we looked at the zoning and we saw, okay, there's additional 3 acres with nothing on it right now as part of this property. And you can build 10 units per acre as far as the density goes in that area. So the way we're looking at it, it's already a good deal as is, we think. We're still kind of working through it, but the potential for a long-term hold and then 9 years, just appreciation on its own, market rate rents go up, and the option to maybe add those 30 additional units to the property that we already own without having to buy that land then at that time. That's a big, that's a great potential play. So we are looking at stuff like that. Absolutely.
Do you see that as a barrier when communicating with potential investors, the more complexity of a business plan that might include adding units, longer hold? I mean, in the syndications that we do, we generally just throw a 5-year hold on it. And if it performs at that, then that sets a pretty good expectation. Or, from your development pool of interested parties, do they have a slightly different mindset? I'm just curious because it seems to the longer the timeline and the more complexity you add to a potential deal, not only is there potentially more risk because if you're planning on building 30 units and for some reason they don't get built, well, now it's reverted back to whatever it was when it existed. Can you just talk about that a little bit, how you communicate or how you might communicate if you haven't already, some of that added layer? Because I want to know, because I haven't figured out how to do it either.
No, there's sort of an art to it, and we're not quite the artists yet that we would want to be in that particular field, because it is, investors don't want to hear very complicated strategies. They want to know, okay, I can get my money back maybe at this year. Okay, I'll make this much per year. Don't overcomplicate things. Excuse me. And so something like that example, we would make sure, the one I just gave, we would make sure they were already getting, kind of the IRR that they would expect to be involved in one of our deals based on the as is situation or the potential just value add on the as is. So, just, or even organic rent growth, whatever it is, we might say, okay, we're going to refinance in year 5 and then hold beyond that, or simply sell in year 5. We would present them with a very, straightforward basic strategy if that worked. And then we'd give sort of an additional, hey, look, we're not, necessarily going in with this mindset, but there's also this potential after the fact that could really boost the returns. We want you to know, here's the basic strategy. It already works as is, because kind of, as you said, the development investors do have a different appetite. So they're a bit more risk averse. They're willing to take on some more risk up here on our development jobs because there's a lot of uncertainty. It might take longer than we anticipate to construct. We may get held up with different permits. So they know going in, okay, I'll probably make more on an annualized basis over these couple years that this thing's going up. But then they also have to sell all the units, which is, a bit harder than, say, just renting a unit. Of course, you're selling a $700,000-800,000 unit. Everyone can't afford that, obviously. So your market's a bit smaller. So there's definitely a different risk appetite. So we try to keep it simple, and we try to present the simplest strategy that can still make the most money for the investors, with maybe in a situation like that kind of a caveat. Hey, look, there's also this bonus opportunity.
Yeah, it's got to be icing.
Yeah,
because if you're doing like, sorry, if you're doing like a hybrid like that where you're intending to hold it, I would call it a covered land play, because we're looking at like a shopping center, like a retail shopping center that has kind of a 5 to 7 year play for developing multifamily up here in Massachusetts. but it's the sort of investor who wants to invest in a stabilized cash flowing asset tends to, you might be the same guy, but a lot of times a different person who wants to invest in the, higher return, but a little bit of volatility there, new construction development project. So marrying the two is kind of difficult. But as Eric said, if you just kind of present it as, hey, this is just icing on the cake at the end. If we do this, you make even more, then it can work. But it'll confuse people if you say, all right, we're going to do this, then we're going to do this, and we need to get all our ducks in a row before you're going to get all your money. That tends to turn people off. So we usually have been doing either hold for a 5 to 10 year term, or a development project with a 1.5 to a 3 year term, depending on the size of the project. And we usually keep them separate, but we're looking at, I guess, multiple deals now where it'd be somewhere in the middle. And we're kind of trying to figure out, I think putting as icing on the cake is probably the best approach for that.
Yeah, I mean, we had some locally that we looked at, had a development side to it. We didn't pursue it ultimately, partly because it was just out of our scope. We don't have development experience. We're like, okay, we're probably taking on more than we should. And then part of it was also, I'm not sure we could sell this to investors with this level of complexity, or at least not to our existing list. So, I think there's plenty of people out there that are interested in all kinds of opportunities. I mean, just look at how many different things you can invest in generally. But whether or not you actually have the infrastructure to switch gears and present something that is out of your, wheelhouse, you might not get the response you hope for. So yeah, it's a bit of a dance. Be careful.
Hey, it's Greg from Real Wealth Solutions. If you'd like to know more about our passive income opportunities, jump onto realwealth.solutions and hit that schedule a call button. We're always happy to talk about our multifamily and flip projects and to answer any questions you may have. Again, that's realwealth.solutions. We look forward to hearing from you. And now, back to the podcast.
So Southeast multifamily, that's where you guys are headed. That's where you are now. You've transacted? What's your portfolio look like around here? Which I guess I call Tennessee Mid-Atlantic, but whatever.
We're looking at Tennessee too. We like Chattanooga. I know.
There's nothing here. Yeah, I would just move on. We've really uncovered every stone.
It's a terrible market.
No, we've put in a bunch of LOIs on different properties that work for us and would work for our investors. We haven't taken one down yet in that region of the country, but we're looking at some markets in Florida. A lot of the MSAs in Florida, besides the Southeast, we're not really interested in Miami, Daytona. We're more interested in like Jacksonville, Tampa, Orlando, even Tallahassee. Maybe it's a little behind some of the others, and decent cap rates still there. Everything else, is compressing to 4, it seems like, or lower. So that's sort of Florida. Georgia we're looking at as well, the whole Atlanta MSA area. Both of the Carolinas, we like a few markets there, and then Alabama and Tennessee as well. So we have broker relationships now in all those states, and we're getting deals every day. We're underwriting them. Like I said, we're putting in LOIs. Our sweet spot right now is probably 100 to 200 units. We think that's kind of the ideal property we want to take down. Obviously, it varies from the city to city in those different states what the cost of something like that would be. But we're looking at, light value add, maybe like a class B we get in, built since the 80s, that type of thing. We don't want to, even though we have the development experience, we're not really looking to get in really deep into something that's, 50% occupied and really boost the value. We're looking to find something where we can boost the value from, a managerial efficiency standpoint, but also some renovation work that maybe we can, get in at whatever, a 4.5 cap. That seems like, depending on the market that we're getting into, boost NOI and hold on to it for 5-10 years, maybe refinance year 5, pay everyone back, and then continue to hold, maybe, exit a better cap. I mean, we anticipate when we underwrite our deals that cap rates will expand so that we can be conservative and we're not assuming an even lower cap. So we have a lot of criteria that we have to make work. But like I said, we've thrown out a bunch of LOIs in those areas. And we're going to keep doing that until we kind of nail down that 100, 200 unit deal.
Yeah.
Do the same thing that we do with the development projects. We see people buying projects and we underwrite it and we say how are they going to make any money?
Right.
Yeah.
So we're patient, we'll underwrite 100, 200 deals. And if that's how long it takes, that's how long it takes.
Yeah, you have to be, and the more you get your presence known and massage those broker relationships, you'll inevitably get that one that comes from a broker before it actually hits the market. That's what you're banking on as you continue to do that. And I guess whatever you guys have now in those areas and you're probably will do third-party management.
That's right. Yep. We have several property managers we've been talking to and working with. So they'll check out some deals for us. And we like to go, obviously the straight third party. So there's no competitive risk and there's, their interests align perfectly with ours. They don't want to manage a lousy property.
Yeah,
but
absolutely.
obviously they want you to take something down that they can work for you on. And also at a scale that maybe some guy in Georgia, a property management company, also operates in Florida. And we can have similar reporting techniques. So everything is really streamlined. So we're kind of setting up that system now so that when we get that second, third property, even we might be able to still work under the same management company.
Are you guys working with any other sponsors or general partners in those areas? Maybe guys you've connected with through the years or have identified since you started looking in those areas?
Yes, we are. We have a guy who's going to be on the GP with us, most likely. He's got 3,600 units that he has, under ownership, high net worth guy. And so he likes to tag on to, as many deals as he can, pretty much in the entire Southeast. And we connected with him through a mortgage broker that we work with down there. So it kind of goes back to what you said earlier about the relationships. I mean, that's a big thing we're noticing in this part of the country as guys who are from the Northeast. One or two relationships that we built down there have really spiraled into meeting, dozens and dozens of other people in the industry that are maybe even sending us deals or suggesting deals or areas, or we can bounce stuff off them. Insurance brokers, even we have a question about, how a broker might be underwriting the insurance cost on a property, and we send it to him. He says, no, this is way off per unit. Or, another property manager who we're looking at, say, repairs, and the broker's estimating, $2,000 a unit. We show it to them. They say, no, this is going to cost you $8,500. So that's something we've really tried to focus on, and it's working so far. It seems to be.
Yeah, and that scale at 100+ units, you're going to be able to get a manager, and you're just buying a small city, you're buying a business. They can drop full-time people in there. It's in being out of state, much easier generally to asset manage large single entity, number of units. We're local, so we're seeing a little bit more opportunity in the 30 to 50 unit area right now. But I think it's just much easier for us to do it than it would be for people that are not in the area. So we're kind of doing that, taking what the market is giving us because we're local, similar to what you did with the condo stuff. But
have you guys found in that unit count, and it can be with any unit count, but I think it's more prevalent in that type of unit count, third-party management company you start to align with, and like you're saying, Eric, maybe they manage it from Georgia and Florida. Let's take advantage of that. A lot of times you can approach these guys and let them get skin in the game, as far as equity on some fashion that just incentivizes them to run your property / their property better. Is that something you guys have thought about? Is it something you want to do, or no big deal? We'll just make it work with them the way they are when you own everything?
We haven't actually approached any about that yet, but someone has mentioned something similar to us, one of our contacts down there, and it is something we're open to if it can help make the particular deal work better, or we feel more comfortable then with them having skin in the game. Yeah, that's not something we're opposed to, but we haven't had any discussions with property managers yet about that.
We like incentive alignment
That's
and
right.
everyone wins. That's always kind of one of our philosophies.
Yeah.
Just see great success with it so far when we approach things like that.
And a lot less of a sort of an adversarial relationship than you end up having, because it's similar to development with contractors. You always want to be on the same page. You don't want to be blaming them for something. If it's not their fault, they start to blame you for not direct. So if we sort of
Yeah.
incentivize everyone, like Nick said, we find that happens less, and it's a smoother process.
Yeah, we're trying to improve and hone that on the contractor side for our flips, and trying to, you know, get to some level of scale. And we've been through all the pains of a contractor on a much larger one of our multifamily projects. But yeah, that's great. I love to hear that.
Yeah, absolutely.
Yeah, just on the the type of investment you're looking for. You mentioned the light value add. We're right there with you because we've done some heavier stuff, and then this one in Kansas, which was built in 2000. The amount of reserves that were required at closing compared to a building that was built in the the 80s was remarkable. I'm like, what? They want $3,500 for one little project that we have to get done in a year. I'm like, let's go. But not only that, you're buying something a little bit newer, codes and things were a little more modern. So the product that you're getting is probably a bit better than a 70s, 80s build when things were a little more of the Wild West, especially in some tertiary markets. But the returns for a heavy or middle value add are about the same pricing wise for things that are a bit newer. So it doesn't seem like the payoff for getting into these heavier lifts from a risk adjusted point of view are there anymore with the current state of the market. Have you seen investor expectations temper at all a little bit with how hot the market has got? At some point an 8 pref was pretty common. You still see that in some areas, but I think generally speaking, syndicators are trying to not scale back returns, but be much more realistic. It's like, it just doesn't work at an 8 pref. We have to make money too. Sorry, guys. We're not doing this as a hobby. I'll go fishing if I want a hobby. What are your thoughts on that? Are investors hopefully paying less attention to massive gains in Bitcoin and expecting real estate to do the same thing?
Depends which investor you're talking about.
Yeah, I know. Well, and like your development guys, I would think that they are probably, correct me if I'm wrong, that it takes a little bit more to get their ears to perk up from like an IRR perspective because they're used to, 2 to 3 year projects. So when you come out and you say, a 13 to 15 IRR with 8 to 10% cash on cash, that might seem very dull to some people.
Yep. Yeah, people are willing to deal with the added risk of development. They're ideally, an investor in my mind would be investing in some development deals, some stabilized value add sort of deals, because then they're diversifying their own funds along the volatility spectrum. But in practice, I feel like people they find what level of risk is tolerable to them, and then they just kind of keep pursuing that tranche or that pathway, and they expect those kind of returns. So if someone said, all right, yeah, I'm fine with the development risk, then they're kind of conditioned to development returns. We have a lot of kind of, I wouldn't say beginner investors, but intermediate investors. So they kind of think in ways like that. They just want to find their path, the thing they like to invest in. And then, so I would say the people we have investing in rental properties and the people we have investing in development properties, we literally separate them in our lists and our databases because we consider them two different types of investors for that reason.
Well, and when you mentioned, when we asked, what are you really looking for in multifamily in the Southeast, and anywhere from 100 to 200, you said we're looking anywhere from going in cap rate at 4 to 4.5. Whereas Greg and I in the smaller unit size are looking at 5.5 to 6 on the actuals, knowing we can get it at least a point or more higher, which I think is exactly what you guys are doing, but you're dealing with more of an institutional type investor. Not that we don't have, accredited people and things of that nature, but that right there is one of the differences in what an investor can expect and or desire, if you will.
Yeah, it's a lot tighter. I mean, like you guys sort of have both hit on here, the expectations. I'll be honest. I think from a syndication standpoint, aside from our development, these compressing cap rates is almost a slight delay from the investor's view of the situation to the actual market playing out, because everything seems to be compressing. But I think we're still getting a lot of feedback that, oh yeah, 8% pref. Yeah, no. We need a 15 IRR. We're sort of still hearing those expectations, even though that's not the reality of the situation. You guys probably know this as well as us, that it's almost like, so the way some of these deals are being priced now, you're paying for pro forma, you're paying a year or two out as if you've already enacted all these changes and upgrades. And now we can refinance out of our bridge loan, and because the lender will actually fund a loan on this. And one of the mortgage brokers we're talking to who deals with agency loans, he said it's the last, I don't know, 6 to 12 months, it's like 90% of his loans are bridge, because they won't work for Fannie or Freddie because they're too overpriced essentially.
I would say,
and they've gotten more competitive too. The bridge
Very
loans.
competitive.
Yeah.
And I would say investors who are out there right now should just be careful, because I'm not looking through everyone's offerings, but there's got to be some people who are putting some rosy projections out there as they're taking down these deals for higher and higher prices. So just do your due diligence if you're going to invest in someone's deal. Make sure that all their assumptions make sense.
Well, and that's like, part of these smaller deals, we're able to just do joint ventures. So it's a little bit easier from the business plan side, get a smaller number of people that are more actively involved on the same page.
But at the same time, obviously, things can go sideways in a joint venture as well, and still vet out your sponsor, if you will, is your point, regardless of the joint venture or syndication. I know of a recent example where I got calls from 2 or 3 people looking at a deal, and there was a wholesaler involved, and that's bad right off the get-go with a multifamily deal.
Usually messy.
Yeah.
Had to close in 3 weeks, and bottom line is one dude lost $50K EMD because he believed in what these people were doing. And I'm like, man, it only takes one to just ruin you for life. I'm not trying to be doom and gloom, but that's a reality that if you don't vet.
Realistic.
Correct.
You have to be careful. I mean, it's just so much money involved that some people are just reckless, and in any area of human pursuit, there's going to be reckless people out there, and you've got to be able to say, oh, that guy's being reckless, I'm not going to do what he does. I got to keep to my own strategy.
Absolutely.
Yeah. Let's talk about just kind of growing your business and brand. You guys started together, are now on another branch of the tree. If that's a fair assessment. I saw on the Winterspring that there are a few other people involved now. You guys are the co-founders. Just looking back on your growth, I'm always curious, are the things that you've identified looking backwards that you say, wow, we should have done that a little bit sooner? Maybe we should have done this a little bit different. That may be either bringing in partners or, before we started recording, you mentioned that you're starting to look at the VA space a little bit more to offload some tasks. Um, yeah, what might have you given your previous self some advice, if you could go back and talk to him about how to get things moving along?
I'm a big history fan. And I actually just wrote an article about this for Forbes that should be published pretty soon. But
Nice.
there's,
Congrats.
yeah, thank you. There's if you look at the history of Japan in the late 1800s, they went from being basically like a medieval country with no modern technology to a world power, like on par with the Western nations. And I always think it's fascinating, like how they do that, because that's very rare in history. It's mostly like the West kind of got an advantage, and it was no other countries could really catch up. But then randomly, Japan did, and I like ever since I was a kid, I was fascinated how they do it. There's this movement in Japan in the late 1800s called the Meiji Restoration, and basically what they did is they just sent their smartest guys out to every country in the West, all these advanced countries, and they studied every part of those countries, their military, their postal system, the economy, basically everything that they do to see how they tick. And then they came back to Japan. They said, all right, America, they got the best economic system. They got the best postal system. The UK, they got the best navy. Germany, they got the best army. And they just kind of took bits and pieces from all the observations they had made and made it their own. No one could accuse them of being not, they're extremely unique culture. But a lot of what they did in the late 1800s was imitate, learn from others, and then kind of make it your own. Don't completely copy carte blanche what other people are doing. Copy those little bits and pieces. You say, hey, I really like that approach. Hey, I really like that approach. Hey, that approach fits me. And I would think if you're starting off, and this is what we should have done from the beginning, we should have, from our first project, looked at what the biggest developers are doing in Boston, looked at what the biggest multifamily investors were doing, and tried to pick up those practices that suited our working style and our goals. And I think you can't really go wrong with that kind of approach like Japan did in the late 1800s. Look at what the best people are doing. Don't copy them, but try to learn from them and say, all right, this is working for them. I can probably integrate this into my business, because it might sound obvious when you say it all out loud, but when you start a company, you're just kind of focused on what's in front of you. Like for the development jobs, there's so much work to do. There's so many steps involved. I almost kind of look at this sort of like conceptualization, learning like new techniques and methods and approaches. I almost look at it as like an R&D side of the business, which is very easy to overlook when you have, a checklist every day from 9 to 5, 9 to 6, 9 to 8 some days, and you just constantly task. Sometimes you need to step back and say like, all right, what are the big guys doing, and how can I start implementing that in my business? So it's kind of an overall like general approach, but that's the thing that, since we started doing that and really looking at what the top level companies are doing, it's really allowed our business to explode in the past couple of years.
Yeah, that's great. No, I thought the same thing when you're talking about the history of Japan. Darren and I read a fair amount on mindset and things like that, and you read some mindset books from the turn of the century. They're talking about things that are still talked about today. And when you have that amount of repetition in your research, it's like, why do I have to keep looking? I think it's pretty clear what maybe the path is, and I just need to dedicate myself to going down it. Quit being a
Absolutely.
strategy jockey so much, and uh, start implementing a little bit more of what is becoming repetitive in what comes to the surface. So
I see there's two types of people that like struggle with getting started, or not getting started, but there's just two types of approaches that can give you trouble. And one is, I tend more towards what you were saying, is analysis paralysis. I just learn, and then, it takes me years to get started. Like we were talking about starting the business for years before we did. And a part of that was I had to save up money. But like my temperament, I believe Eric's similar, is analyze, learn everything before you start, which is impossible. Eventually you got to just get going. And then there's the other type of approach where the guy who's just kind of go. He didn't really do much analysis at all. And those guys actually, some of them are pretty successful because if you just dive in, you'll learn it anyways, right? So I would say err towards the side of analysis paralysis, like do a lot of homework before you jump in, but you got to be somewhere in the middle. If you're just jumping in with no analysis, you'll probably pick stuff up on the way. And some guys just jump in and then they're wildly successful, but then other guys eventually they hit a roadblock and they lose all their money. So that's a reckless approach. And then analysis paralysis, that side of things is you could be extremely knowledgeable about a subject, more knowledgeable than a person who's more successful than you because you haven't done anything. So you got to find that middle ground between, all right, I've done my homework, but I don't know everything yet, but it's time to get started. So if you're just getting started out, try to find a middle ground between those two approaches.
Yeah, no doubt, because the research and the study is great, but once day one you own a property, it's like, well, okay, now we're dealing with a living, existing single property on a single parcel with a completely different set of tenants than any other property on the face of the earth. So you're dealing with a living, breathing organism, and the theory has to put into practice at some point. It'll get you a lot of the way there, but hey, man, every day, I'm sure you run into it on the development side. You shove that shovel into the ground and something comes up and nobody expected. You're like, oh, well, I guess we'll figure that out.
You have to be basically willing to say stuff is going to happen that is on nobody's radar. Right. But when it happens, I'm going to figure out how to approach it.
Yeah, it's a little nerve-wracking the first few times it happens. But I mean, when you're like, oh, okay, what are we going to do? I guess we'll just figure it out,
Exactly. Yeah. The first few times, as you just said, that happened, it was like, oh, this is the biggest situation right now we have to deal with. There's nothing more serious than this. And then the next week, this is the biggest situation we've ever dealt in. And then you start to realize, okay, you kind of become a little desensitized to it, but also, look, this is going to happen. This is part of it. This isn't a unique thing. This might happen weekly, and we just have to take it in stride, expect something to not go as planned, and then deal with it and move on to the next thing that won't go as planned.
Yeah. I was just going to say, be solution based, because there's been a couple times, it was one particular deal where I'm like, Darren, I mean, we're just wrecked. There's no way this is, I was like, well, this is over. I'm going to have to make some extremely uncomfortable phone calls, but we found a solution. And I was like, oh, okay, wow.
Us too.
We're still alive. I was like, okay, let's go. We got another day.
I think we've learned, I think in similar to what you guys are saying, we've learned to pivot when the time is needed, and you do become desensitized to it because you realize it's a part of business. But kind of going back to what you guys were saying before, and Greg was kind of saying, it's execution, it's daily execution. And one thing that I think we have gotten better at, whereas before we were kind of timid and didn't want to step on anybody's toes, and we're increasingly becoming more, is that this is our business. We're going to run it the way that suits us. And if not everyone likes it, too bad. And I know that sounds harsh, but I guess I'm saying we're making more concrete decisions more quickly. And if it hurts someone's feelings along the way, whether it's a contractor, whether it's a supplier, whether it's even a partner investor, you know what? We're decent now at what we're doing. We believe in what we're doing. And so I think that comes with time and practice as well. You get a level of confidence and level of experience. I know that's kind of not where we're going, but that's another phase of growing, if you will.
Absolutely.
You are what you tolerate. And so, like, for example, we're about to bring management in-house, and because we're tired of tolerating what we're tolerating. And that's not to poo-poo on third-party management by any means, but we're able to do it, and that's what we're going to do.
Yeah.
Yeah, and I would say it's like we talked about the desensitization, that it's not you get desensitized to things going wrong and that you don't care about when things go sideways, is that you become desensitized to the potential negativity of it. It's less of
The emotion.
yeah, it's less of we're crushed. It's more of like, oh, here's a challenge we have to overcome. It hits you a little bit differently.
Right.
You take it as seriously as anything else, but you having, crawled over a few barriers, you're like, okay, we could probably crawl over this one too. We just have to put in the work. So
If the sky's falling every day and you keep surviving, you just kind of get used to it.
Yeah.
yeah, right.
And one thing we try to do is Nick kind of brought this into our company is read a lot of stoicism and sort of practice stoic techniques where it's, there are also so many stoic passages sort of follow a similar principle that it's kind of, live and let live and just sort of don't let the little things bother you. And like you just said, it's not that you're desensitized to the issue. It's no big deal. It is a big deal, but it's how you react to it. I think Darren said that too. The emotional reaction doesn't have to take up so much of your energy and time just on that part of it. You can still get a solution without wasting so much time and energy reacting emotionally or negatively to something.
Yeah,
right. Yeah, you
business.
could spend time being upset about it, or you could spend time solving the problem.
That's right.
Yeah. So how do you want to spend your time? But yeah, I think that's a good spot to wrap up.
I got one question for Nick.
Oh, okay. Go ahead.
I want to know more about this Forbes article and when it comes out,
okay.
how we can get it. And is this something you do on a normal basis, write for some publications or whatnot?
This will be my first, but I've got a couple that I've written. They're all about running a business, kind of not real estate specific. It should be coming out this week or next week. They kind of go through an internal editor process, and then they publish it. But I think it should be coming out this week. So,
will you have a link to it on your website, perhaps?
Yeah. I'd really appreciate if anyone wanted to check it out. I think it's a pretty interesting topic, and I'll be writing similar topics in the upcoming weeks and months as well. If anyone likes my approach.
That sounds fascinating to me. I'm a history buff myself. Were you a history major by chance?
Minor. So
minor. Okay.
But that was like, I learned much more. I feel like I learned more from the lessons are abstract and they're hard to apply, but if you put enough thought into them, you're like, I feel like I got a grasp on this planet Earth to some
That's
degree,
cool. That's real cool. Yeah.
Just knowing Nick, I feel like I graduated with a BA in history.
I talk his ear off. Like if you get to know me well, and you don't like history, you might want to try to avoid me when you see me.
That's great.
It doesn't seem like you tend to minor in what you really enjoy, but major in something that you think will actually make you money.
Yeah.
Yeah.
It's the nature of the beast here. The world.
Yeah, it is. It's all good. But yeah, I spent some time on Winterspring Capital at the sharp looking site, very heavy on investor education, a lot of resources. So I want to make sure we direct people to that. We'll put it in the show notes. But yeah, kudos to you. I really like seeing that. It's not all just rah, rah, rah. Look at our portfolio, how cool we are. You're spending a lot of time just giving people information, and it's not always Winterspring specific. It's, hey, here's some good stuff. We hope you enjoy it, and there's always the option to connect with you guys directly if you're interested in having a conversation about investing and stuff. But besides what we'll put in the show notes, is there anything you wanted to put out on the podcast here for connecting with you guys, just verbally?
You could always reach out to us by email. My email is Nick, Nick, at winterspringcapital.com, and Eric's is ERIC, Eric at winterspringcapital.com. And yeah, as you said, we got a bunch of educational materials on the site. Some of it's aimed towards more advanced people. Some of it's aimed towards just getting started out in real estate. I hope people of all education levels and wherever you're at in your journey. I hope I could help someone with something I've written on there. I wrote on a bunch of different topics, so hopefully it helps someone.
And we have
Yeah.
a decent social media presence across a few accounts, Instagram, LinkedIn. We try to post tidbits and resources through there as well, both Winterspring Capital.
Awesome.
Well, thank you.
I just want to say you guys seem incredibly humble, and I really am grateful for the opportunity to kind of get to chat with you and know you a little bit better, and congrats on your success. And who knows, man, we're always looking to help people in the Southeast, whether that's partnering or asset management or bringing capital or whatnot. So just want to throw that out there as well.
That'd be great. It'd be
Fantastic.
great to partner someday.
Hey, one side note, are Bruins, are they in the playoffs?
They're out. They were.
So do you care about the Islanders at all then? Or do you just like, screw it, the Bruins are out, I'm just turning off hockey?
The latter.
Okay. I was on a call with another friend last night, and we found out that we could watch playoff hockey on TV, which we didn't realize because we don't watch a lot of TV. And it's one of the few sports I enjoy watching. And I brought up the Islanders. We were watching Tampa and the Islanders. He goes, I'm more of a Rangers guy. I'm like, oh, you guys are, I forgot how many choices you have up there in the Northeast, you know. It's so
they have two of everything, it seems like, in New York. That's
Yeah, right.
So, but all right. Besides a little side note there, but yeah, thank you everybody for joining us here on the Real Wealth Solutions podcast. If you found this episode helpful, we certainly appreciate it if you shared with somebody directly. And something new we're adding to our show notes is our newsletter sign up. We are made that a priority of ours to try to get more people reading our newsletter. So if you're interested in learning more about us, please subscribe. There'll be a link in the show notes directly to our newsletter. Darren, you got anything to add?
No, I'm good. Take us out.
All right. I think I did just take us out. Nick, Eric, again, thanks for your time. Great conversation. I don't know a lot about development, so I'm always curious to talk to somebody that does. So I appreciate it personally. So
Thanks so much for having us, guys.
oh yeah,
Thank you,
no
guys.
worries. All right, we will see you all on the next episode.